VOO and VTV are both Vanguard ETFs, but they focus on different investment strategies. Choosing between them depends on whether you want broad market exposure or a focus on value stocks. VOO, or the Vanguard S&P 500 ETF, tracks the S&P 500 index, which includes 500 of the largest U.S. companies across various sectors. This means VOO gives you exposure to companies like Apple, Microsoft, Amazon, and Tesla, making it a great choice for investors looking for broad market diversification and long-term growth. Because it focuses on large, established companies, VOO is considered a core holding for many investors. It has a low expense ratio of 0.03%, making it one of the cheapest ways to invest in the overall U.S. stock market. VTV, or the Vanguard Value ETF, takes a different approach by focusing on value stocks. It tracks the CRSP U.S. Large Cap Value Index, which includes companies that are considered undervalued based on financial metrics like price to earnings, PE ratio, and price to book, PAB ratio. Value stocks tend to be more stable and slower growing, often including industries like finance, energy, and consumer goods. Companies in VEV include Berkshire Hathaway, Johnson & Johnson, JP Morgan Chase, and ExxonMobil. Since value stocks typically pay higher dividends, VTV is often preferred by income-focused investors. The key difference between VOO and VTV comes down to growth versus value investing. VOO includes both growth and value stocks, while VTV focuses only on value stocks. This means VOO tends to perform better during bull markets, when high-growth tech stocks are leading the way, while VTV can perform better during economic downturns, when investors prefer more stable, dividend-paying companies. Another difference is sector exposure. VOO has significant exposure to technology stocks, making up about 28% of the fund, while VTV is more weighted toward financials, healthcare, and industrials with much lower tech exposure. This means VOO benefits more when tech stocks rise, while VTV does better when financial and industrial sectors outperform. Performance history also reflects these differences. Over the past decade, VOO has significantly outperformed VTV, primarily because of the strong growth of tech stocks. However, during periods of market volatility, VEV has held up better because value stocks tend to be more stable. Investors who prefer long-term growth potential may find VOO to be the better choice, while those who want lower volatility and more dividends may prefer VTV. Dividends are another important factor. VTV generally has a higher dividend yield than VOO, since value stocks tend to distribute more earnings to shareholders. This makes VTV a better choice for income-focused investors, while VOO is better for total return investors who want both growth and dividends. So which one is better? VOO is ideal for investors who want broad market exposure, including both growth and value stocks, and are looking for long-term capital appreciation. It's a strong choice for a core portfolio holding because of its diversified exposure to the entire S&P 500. VTV is better for investors who prefer a more conservative approach with lower volatility and higher dividends, making it a good option for those focused on income and stability. The best choice depends on whether you prefer a balanced market approach or a focus on undervalued, dividend-paying stocks.